Welcome back in. When it comes to investing, a certificate of deposit, most commonly known as a CD, is it a safe bet? Well, not necessarily. Stewart Welch from the Welch Group joins us to explain a little bit, give his insight on this. Okay, so, a lot of folks, I'm sure, my parents thought CDs were a sure thing. Are they not sure things?
So I think everybody thinks if I've got my money in a CD, it's safe. And it's not necessarily. So I did checking around, looked at two of the largest banks here in Birmingham. And on a 1-year CD, they were not paying 1%, they were paying 1/10 of 1%.
Ooh.
And so, CD produces interest is taxable, but also what I call the stealth tax is inflation.
Okay.
So, and most people discount inflation to zero, and it is not zero. So right now it's running about 1.7%. So if you're earning 1/10 of 1%, you're actually losing 1.6%. And people don't think about that. They just think my money's safe.
Yeah.
So we talk about what should you do. And I think the first thing to do is understand what you're earning and what your real return is after both taxes and inflation. It'll be a little bit different for everybody because they're in they'll be in different tax breaks. So when is CD appropriate? So if you're going to need the money within 5 years or less, something like a CD is very appropriate. But here's what I would tell you is you want to shop rates. You don't want to settle for 1/10 of 1% when you can get maybe 2%. And a good place to go is a place called bankrate.com, www.bankrate.com. So if you don't need the money for, let's say, 10 years, I think you're going to be better off in stocks.
Because you're going to get a better return by historical standards.
Yeah,
over that period of time than you would in a CD.
Historically, stocks earn about twice what fixed income does, and they earn, on average of say 7 to 9%, or maybe even a little more than that. And so they're going to be much better investment in the alternative.
Let's just say somebody is, though, invested in the stock market, and maybe they're a little nervous about what's going to happen with the tariffs with China and what's going to happen with the global economy that could affect our economy. Now, I know your answer, but I'm going to ask it anyway. So should they take a lot of that money and then move it into CDs and say, well, I'm just going to leave it there for 5 years. I know I'm not going to make a lot of money, but at least my money's going to be there, not going to be hit by the stock market.
Of course, if you had guessed that 5 years ago, you'd be so wrong.
Yes, you would.
It would be ridiculous. I do think that you want to keep enough money in CD type things to cover at least 2 or 3, maybe 4 or 5 years worth of cash flow that you need to pay bills.
Okay.
And I think beyond that, you're going to want to have that. You're going to want to have that in the stock market. And what I would suggest is that you consider like the big blue chip stocks, the ones that pay dividend, have a history of raising dividends. That might be an Exxon or an AT&T.
All right, certainly something to discuss with your financial planner to get those ratios right for you and your situation. Stewart, thank you so much. Appreciate it.
Thanks, Mike.
All right, still ahead now, the Mayflower setting